Are you tired of paying Uncle Sam half your income? Unfortunately, if you're a doctor or other high income professional, you're limited to the number of ways that you can actually lower your taxes. But one of the secrets the wealthy use, which happens to be one of the most powerful tax strategies on the planet, is something called, well, we're going to discuss it today, REPS, or real estate professional status. But it does take some work in order to qualify, which is exactly what we're going to discuss in this video today. If you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race with passive income and lowering your taxes. You can download the free passive income guide I put together just for you below this video. Unfortunately, most doctors and other professionals have very few tax advantages due to mainly two reasons. First one is their employment status. The second one is their high income status. Let's start off with the employment status first. So most doctors, they complete training and they go to work for either a hospital or a group. Same thing goes with other professionals like an attorney. You get out, most of the time you're not going to start your own practice, you're probably going to join a group. So regarding the doctors, they go to a hospital, they join a group. And this is really due to the fact that it costs an arm and a leg, no pun intended, costs an arm and a leg to either buy a practice or start one from scratch, especially when that person is in tremendous student loan debt. Because of their employment structure, they're paid mainly as a W-2 earner or 1099 status. Unfortunately, this results in very few tax losses versus someone that chooses the self-employed route, which I chose to do that after I was an employee, went the self-employed route. So somebody that chooses to be self-employed allows them to deduct expenses through their respective business or practice. The second issue that they're having is their high income status. So most tax advantages out there are given to people whenever they're very successful, but also we're actually punished, we're criticized a lot of times if you're successful, you make a lot of money, you're successful, thus you're going to get taxed more. So we're actually, when you think about it, we're actually punished for making a good income, which is usually acquired by what? We have to sacrifice our time, energy, and money to get the training. Also, don't forget about the hundreds of thousands of dollars of student loans most of us have to take out just to obtain our coveted degree. And because of our high income status, many of the tax deductions are actually phased out above a certain income level. Have you ever given your CPA medical expense or student loan records you've paid only to be told that, you know what, you can't claim these because you have a certain high income level? Sucks, doesn't it? Now, don't get too upset because there are several ways that you can lower your taxes as long as you have a good CPA on your team. Disclaimer here, I'm not an accountant, I'm not an attorney, I'm not a financial advisor, so please consult your own team of professionals about the topics that we're covering in today's video. End of disclaimer. Now, one of the biggest kept secrets that can significantly reduce your tax burden is something that, like I mentioned earlier, it's called real estate professional status. So, Jeff, what exactly is this real estate professional status? I've heard it tossed around a little bit, so what exactly is it? Glad you asked. Real estate professional status is a designation given by our friends over at the IRS to a person that actually qualifies to claim that they work on real estate properties and related real estate work the majority of the time. So as you can imagine, there are certain requirements to claim this status, which I'm going to go over in a little bit more in detail shortly. Before we discuss the qualification requirements, let's take a look at actually how these rules started in the first place. Let's give you just a very brief history lesson on the real estate professional rules. IRS Code Section 469, which is basically passive activity loss rules and credits limited, it actually states that losses from a passive activity, are only used to offset income from a passive activity. So basically, passive losses are only deductible against passive income, okay? So a passive activity is one involving a trade or business in which the taxpayer does not materially participate in. Rental real estate activities are generally considered passive activities regardless of whether the taxpayer materially participates or not. Thus, the passive losses from such activities are usually only deductible against passive income. As a side note, many people think that if they go out and they invest in a real estate syndication, if they do that, that's going to offset their active income. If they're a doctor, they think, hey, Jeff, I want to start investing in these syndications alongside of you because I want to reduce my practice income. Well, according to these rules the IRS gives us, you cannot, because remember, passive losses that you're going to get from investing in these syndications are only used to deduct the passive income, the distributions that you get either every quarter or every month. Okay. So under IRS Code Section 469C7, any taxpayer that meets the qualification of a real estate professional, then they actually overcome the presumption that all rental activities are passive, which is good news for the high income earner wanting options to actually lower their business and practice income for tax purposes. Now, in 1993, Congress actually recognized the issues that treating all rental activities as passive, and they sought to provide an exception to a very narrow category of taxpayers, thus the real estate professional. Okay. Now, because of this, they added that section that I talked to you about just earlier, 467C7, 469C7. Now, this stated that a taxpayer who qualifies as a real estate professional, they overcome the presumption that all rental activities are passive as long as they establish that they materially participate in a rental real estate activity. By doing this, then the activity will be considered non-passive. All right. So how do you qualify for this real estate professional tax status? Okay. The IRS requirement states that you must meet a few conditions. The first one is you must spend the majority of your time, actually more than 50% of your time, in real property businesses in which you materially participate. Okay. The second is the taxpayer must spend 750 hours or more in the real property business and the real estate rentals in which they materially participate. So this actually comes out to being roughly about 15 hours per week. Now, some of the activities that the IRS states meet this professional status requirements, they include real property development or redevelopment, acquiring properties, property acquisition, rental management, any type of construction, brokerage, trade or business operations, anything like that. To discuss this a bit further, materially participating means the person is actively involved in operations of the activity on a basis that's regular, continuous, and substantial. Now, whenever I personally invest in real estate syndications, I'm investing as a limited partner, an LP, a limited partner in an LLC that holds the property. Okay, you have the general partner, that's the group that manages everything. You have the limited partner, the passive investor. They go in together, they invest, they put their money in this LLC, which actually holds the property. Typically, no interest in a limited partnership as a limited partner is treated as an interest with respect to which a taxpayer materially participates. So there's actually 7 material participation tests and to become a real estate professional status. All right, there's 7 of them, and you only need to meet one of these. And if you meet one of these, then you're considered a real estate professional. Again, if you want to go through this, I highly recommend you have somebody that you're consulting with, particularly an attorney or an accountant with real estate background. You can go over and make sure that you stay on track if you're trying to go through one of these tests, okay? The first one is you participate in the real estate activity for more than 500 hours. Again, you only need to meet one of these, not all 7. You just need to meet one of these, okay? Second, your participation was substantially all the participation in the activity of all individuals for the tax year, including individuals who are not owners of interest in the activity for that year. Third, you participate in the activity for more than 100 hours during the tax year and you participated in at least as much as any other single person, including individuals who didn't own any interest in the activity for the year. Fourth, the activity is a significant participation activity, and you participated in all significant participation activities for more than 500 hours. Fifth, you materially participated in the activity for any 5 tax years, whether or not consecutive, during the 10 tax years that immediately precede the tax year. Six, the activity is a personal service activity in which you materially participated for any 3, whether or not consecutive, so any 3 preceding tax years. Now, an activity is a personal service activity if it involves the performance of personal services in the fields of health. This could include veterinary services, in the fields of law, engineering, architecture, accounting, performing arts, consulting, or any other trade or business in which capital isn't a material income producing factor. And last but not least, number 7, based on all the facts and circumstances, you individually participated in the activity on a regular, a consistent, a continuous, and a substantial basis during the year. All right, I know that's a mouthful. I know that was a lot. That's why I really recommend that you have an accountant that makes sure that you're going to meet at least one of these tests. And then if you are able to file real estate professional status, they keep you on track. They keep the documentation that you're going to need, that sort of thing. So in case you're audited, okay? All of this to be said is, why would you go through all this? What are the benefits, or what's the main benefit? So one of the main reasons I started investing in real estate was to begin replacing my ordinary income, my dental income, with passive income. Okay, remember I if you haven't watched some of my other videos, had a wrist injury. I realized, hey, I'm only relying on my hands to produce money, with dentistry for my family. Very risky. So I knew I had to start replacing some of that dental income with passive income. And the more that I learned about real estate investments, the more excited I became regarding other benefits with real estate, such as, you've got your tenants out there, they're paying for the property that you own. You have tenants not only paying your property off, they're paying for your expenses, they're paying your mortgage, they're paying down your debt, plus they're putting money, after that's all said and done, what's left over is a net operating income. That's putting money in your pocket. That's what's replacing your active income. That's the main reason why I got into real estate. But then I started learning about all the numerous tax benefits, such as depreciation. Then, just when I thought that investing in real estate couldn't get any better, I found out about even more perks available to those, again, that qualify for this real estate professional status. This specific designation, this real estate professional status designation, it allows you to deduct business expenses, rental losses, and rental property depreciation from, get this, your overall taxable income. That's big right there, okay? Remember, we talked about over here, when you have passive losses like in syndications, you're only able to take that to offset, you're only able to take that and deduct against the passive income. So the passive losses will help offset the passive income. Over here, what we're talking about is, if you're a real estate professional, you can take these from the rental property that you can get, from the depreciation, from business expenses, all the expenses needed to basically operate the property, management, cutting the grass, all of that, the expenses, the loss and depreciation, that can not only offset the income from the property, but your overall taxable income, whether you're a doctor, attorney, whatever. How cool is that? Very cool. That's why this thing is huge. Now, on the flip side, a person who doesn't qualify for this rep status, again, would only be able to use losses as a way to offset their rental income or their capital gains. Now, this isn't exactly a bad thing, because, once I started investing in syndications, remember the depreciation, whenever you invest in a syndication, the depreciation that you're going to get each year, that's going to be reflected on a K-1 tax form that the the group, the general partner group, is going to give you every year to file, give to your accountant. And again, it allows the passive income, basically, that you're going to be getting every quarter, every month, whatever, to essentially be tax-free. Try to get that in the stock market. I don't think so. All right, so let me give you just a very, very simple, a very basic, I want to keep this as simple as possible, very simple example, okay, of this in action, okay? So Dr. S, he's tired of the stock market. He's got 100 grand sitting in a checking account. He takes that 100 grand, he invests in a syndication, apartment syndication in North Carolina, okay? The general partners of this group, they're able to still take advantage of bonus depreciation. So that's going to basically accelerate the losses for the first year. Now, on that K1 tax form that he gets after the first year, the group gives to him, the general partner gives to the limited partners. It's going to show on this K1 tax form, it's going to show and that he was able to capture a $30,000 loss. Okay. Now, during that year, his dental income was actually $230,000. Okay. If he files as a real estate professional, so he files his taxes, he's a real estate professional, he is able to take that $30,000 and deduct it from his $230,000 dental practice income. What this is going to do, this is going to lower his overall, remember, it lowers your overall taxable income from $230,000 to $200,000. Okay, so actually this is going to allow his income to decrease by the amount of depreciation. Thus, he's only, instead of being taxed on 230, he's taxed on 200. Okay. Now, if he didn't meet the real estate professional requirement, again, the losses that he would get, the losses on this K1 could only be used to decrease the passive income that he gets paid out every quarter from the project. Again, investing in a syndication, getting tax-free quarterly or monthly income, passive income to replace your active income, that ain't bad. Again, try getting that in the stock market. It's not going to happen. Okay. But to bump it up a huge another notch, if you can figure out how to become a real estate professional, that's a game changer. I mean, this is how a lot of these people, a lot of these really, really wealthy people pay like zero in taxes. Kind of to summarize here, one of the top advantages to real estate investing is all of the numerous tax benefits that's available. Because of this, it's very important to understand, again, work with a good team, qualified professionals, real estate professionals. It's very important to understand, even though you use them, you got to be able to use them properly and use them to your advantage. Now, investors are able to benefit, again, by using depreciation and losses to their advantage by becoming a real estate professional. Now, if you want more information about becoming a real estate professional, again, consult with a qualified tax professional, and then you're going to be well on your way to a much lower tax bill. Speaking of qualified tax professional, what I want you to do is check out this video over here where I interview Robert Kiyosaki, Rich Dad Poor Dad author, Robert Kiyosaki's personal accountant, Tom Wheelwright, where he's going to discuss the different tax loopholes the rich use to pay zero taxes. Check it out over here. Later.